I want you to picture something for a second. Right now, at this very moment, there are nearly 1 million people just suspended in the air.
It's a wild thought when you really stop to visualize it.
A literal city in the clouds, population the size of Austin, Texas, just
Yeah.
floating at 30,000 feet.
And completely reliant on some incredibly complex technology to stay up there.
Exactly. And for a massive chunk of that floating city, the only thing keeping them safely aloft is technology from the company we're diving into today.
That company being the industrial giant GE Aerospace.
You're doing a deep dive into their Q4 2025 earnings report, which just dropped on January 22nd, 2026. And I know the phrase earnings report can sound pretty dry.
That's homework, yeah.
But this isn't just a balance sheet. This is a story. It's about a company trying to, and I'm quoting your CEO here, invent the future of flight.
All while managing a backlog of orders so big it's almost hard to comprehend.
I mean, we're talking about a $190 billion backlog. So our mission today is to figure out, how do they even begin to deliver on that? We'll unpack their flight deck strategy and explain the strange paradox of why selling a brand new jet engine is often the worst part of their business.
At least at first, it's the central tension of the whole industry.
Okay, let's get into it.
Let's do it.
So we have to start with the big numbers. The CEO, Larry Culp, called 2025 outstanding. Now, CEOs always say things like that, right? Pivotal, transformational. But does the math actually back up the word outstanding?
Well, in this case, it's not just cheerleading. The numbers are definitely there. For the fourth quarter alone, you're looking at revenue of $11.9 billion.
And that's up 20% on an adjusted basis.
Exactly. So that's the real apples-to-apples number. For the full year, they pulled in nearly $46 billion. But the figure that really got Wall Street's attention was the profit.
The bottom line.
Right. Operating profit for the quarter grew to $2.3 billion. And the earnings per share, the EPS, came in at $1.57.
Which beat expectations, didn't it? I thought the consensus was lower.
It was. The street was expecting $1.44. So they didn't just meet the bar, they cleared it pretty comfortably.
By 13 cents. That's a solid beat.
It is. But if you ask me, the real wow stat, the one that tells you about the future, isn't the profit, it's the orders.
Oh, I saw this. This number is wild. Q4 orders were up. What was it?
74%.
74%. That's not just growth. That's a demand shock. Is that just a post-pandemic travel explosion?
That's a huge part of it. The travel boom is not cooling down. But you also have airlines needing to replace older, less fuel-efficient planes. And that surge is what pushed their total backlog up to that $190 billion number.
Okay, let's pause on that. $190 billion. That's up nearly $20 billion in just 1 year.
It is.
I mean, on one hand, that's incredible job security, right? But on the other, doesn't that create just a terrifying amount of pressure to actually build and deliver all of it?
It's the ultimate double-edged sword. A backlog that big is a massive asset, but if your supply chain can't keep up, it can become a huge liability. You get angry customers, penalties. It's a lot to manage.
So looking forward to 2026, are they confident they can manage it?
Their outlook says they are. They're projecting low double-digit revenue growth. And here's the big one. They expect operating profit to be somewhere between $9.85 and $10.25 billion.
So they're planning to crack the $10 billion profit mark for the first time.
Which is a huge signal of confidence. It says they believe the demand is here to stay, and they believe they're finally getting the supply chain issues under control.
Okay, so that brings up the business model.
Yeah.
I think most people imagine GE builds an engine, sells it to Boeing, and that's the end of the deal.
And that is the biggest misconception about this business. If that were the model, GE Aerospace would be a much, much less profitable company.
That's the old razor and blade model, isn't it?
Exactly. But on an industrial scale, that's hard to fathom. The engine is the razor. You might even sell it at a loss.
Just to get them hooked on the blades.
Precisely. The real money, the recurring revenue, comes from the blades. The maintenance, the parts, the overhauls, the services.
So when I see in the report that service orders were up 27% for the year, that's the real engine of the business.
That's the engine of the engine business, yes. You have to remember, GE has an installed base of about 80,000 engines currently flying.
80,000. That's a massive captive audience.
It is. And the airlines stick with GE for service because it protects the value of their asset, the plane, and it guarantees reliability.
Ah, so it actually lowers their total cost of ownership over time.
It does. A plane that's stuck on the ground waiting for a part is a black hole for money. Paying for GE's premium service is cheaper than having a grounded fleet.
So this MRO, maintenance, repair, and overhaul, that's the backbone. And I saw they're investing a huge amount of money into it.
$1 billion just to expand their MRO network.
$1 billion, just to build more repair shops.
Basically, yeah. And half of that, $500 million, is specifically for the WT engine. They're building up capacity in Brazil, Malaysia, Dubai, Dallas, everywhere. They know they have to service what they sell.
Which brings us to this flight deck thing you mentioned. It sounds cool, but what is it, actually?
It's their lean operating model. Think of it as a philosophy, a set of rules for how to run the business. And the most important part is the order of priorities that Larry Culp insists on.
Which is?
Safety, quality, delivery, and cost. SQDC, in that exact order.
That feels counterintuitive. You'd think cost or delivery would be number one for a public company.
And that's the trap. The logic here is that if you focus maniacally on safety and quality first, you stop making mistakes. If you stop redoing work, your delivery times get shorter and your costs go down as a natural result.
Slow is smooth. Smooth is fast.
That's the idea, and they have proof it's working.
Okay, like what?
Well, they cited their facility in Wales. They used the flight deck system there and improved the turnaround time for the CFM56 engine by 20%.
20%. That's a massive deal for an airline.
It's huge. And at their Selma facility, they're keeping overall times below 80 days, which is a gold standard. Even their suppliers are getting on board. Their priority suppliers boosted material input by over 40% last year.
So the bottleneck in the supply chain is finally starting to loosen up.
It's moving. It's not perfect, but it's getting significantly better.
All right, let's talk about the actual tech. The engines. We have to start with the ULI AP engine, the one on the 737 MAX and the A320neo. This is the star of the show.
It absolutely is. It's their present and their future. They delivered over 1,800 of them in 2025 alone, which is up 28%.
And I saw a note about its profitability that really surprised me. They're expecting the ULI AP OE, that's original equipment, the actual new engine, to be profitable in 2026.
Yes, and that is a massive financial turning point.
Because usually you lose money on the new hardware for years, right?
3 years. It means they've finally climbed the learning curve. They've figured out how to build them efficiently enough to turn a profit on the sale itself, not just the service contract.
But there's another piece to this, something called time on wing.
Right. It's maybe the most important metric for an airline. How long can an engine fly before it needs to come off for major service?
More time on wing means more revenue.
Exactly. And GE just introduced what they call a durability kit for the LEAP-1A.
A durability kit. Sounds like a video game upgrade.
It kind of is, and it doubles the time on wing. It brings the LEAP-1A's performance right up to the level of the legendary CFM56, which is known for being basically indestructible.
And they're doing this for other engines, too.
They are. For the GX, the engine on the Dreamliner, they've introduced a new turbine blade that improves time on wing by 2.5 times, specifically in hot and harsh environments.
So places like the Middle East where sand and heat just eat engines alive.
Precisely. An improvement like that is a game changer for airlines operating there.
Okay, so LEAP is a star, GX is getting tougher, but we have to talk about the giant in the room, the GE9X.
The biggest jet engine in the world for the new Boeing 777X.
And it sounds like it's a bit of a money pit at the moment.
Well, management was very open about it. It's a financial drag. They lost, and I quote, a couple $100 million on it in 2025.
A couple $100 million. Ouch.
And it gets worse. They said those losses are expected to double in 2026.
Wait, hold on. Why would the losses double? Are they getting worse at making them?
No, it's because they're making more of them as they ramp up production.
The more they sell, the more money they lose. That sounds like a terrible business plan.
It sounds insane, I know. But this is the razor and blade model in its most extreme form. They are knowingly losing hundreds of millions now, burning cash to build the first batch.
So they can lock in 30 years of high-margin service contracts on the back end.
That's the bet. Swallow the poison today to feast for decades to come. They're buying their future revenue stream.
Speaking of the future, let's look at the other side of the business, defense.
Right. Defense and propulsion technologies. And with global tensions being what they are, that business is blooming.
How much is it booming?
Orders were up 61% in the fourth quarter.
61%. Wow.
What was the driver there?
A huge win from India. Hindustan Aeronautics ordered 113 F-404 engines for their Tejas fighter jets. And for the finance people listening, their book-to-bill ratio in defense is above 2.
Okay, break that down. What's a book-to-bill ratio?
It's simple. It compares the orders you're booking to the products you're shipping or billing. A ratio of 2 means for every one engine they ship, they're booking orders for 2 new ones.
So work is coming in twice as fast as it's going out.
Exactly.
Yeah.
Which, again, goes right back to that pressure on the supply chain to deliver.
And they aren't just delivering today's tech. They're spending nearly $3 billion a year on R&D.
$3 billion. That's a serious commitment.
What's that money going toward? Is it just making current engines a tiny bit better?
Some of it is, but a lot of it is going toward what you might call sci-fi stuff that's becoming real. A big focus is the RISE program, which is about sustainable aviation.
And they hit a milestone there,
Right.
a major one. They just completed a ground test campaign for a hybrid electric narrow-body engine.
Hybrid electric, like a Prius for the sky.
That's the concept, yeah. Using electric motors to supplement the gas turbine to cut emissions. Moving that from a drawing to a physical test article is a huge leap forward. It shows they're serious about disrupting themselves before someone else does.
Now, with all these changes, you'd expect to see some shifts in leadership.
And we did. Some significant ones. They're combining their technology and operations teams into the main commercial engines and services unit.
What does that mean in practice?
It's about breaking down silos. The engineers designing the engine are now on the same team as the supply chain folks figuring out how to build it.
So they can solve problems faster without throwing designs over the wall.
Exactly. And they also elevated a role focused on customer experience to report directly to the CEO, which is a clear signal they know they need to keep airlines happy during this ramp-up.
And we should also mention Russell Stokes is retiring after 29 years.
A long and impressive career, a real changing of the guard, but the strategy feels very locked in.
Okay, so let's try to tie this all together. We have a company that had an outstanding year. Orders are through the roof.
And they have a clear, disciplined strategy with flight deck to actually execute on that massive backlog.
What's the one big thing that stands out to you from all of this?
For me, it has to be the power and resilience of the services model. That aftermarket business is a fortress. Even with supply chain pain and hundreds of millions in losses on the GE9X, that river of cash from maintaining 80,000 engines just keeps flowing.
It buys them time to figure out the hard stuff.
It buys them time and it funds the future. It's what allows them to spend $3 billion on R&D and absorb the initial losses on new programs. They're not just selling a product, they're managing the entire life cycle of flight.
It's the long game. They're betting big that no matter what happens with the economy or geopolitics, the fundamental human desire to connect.
And the need for nations to defend themselves.
Those things aren't going away.
They certainly are not.
But that leaves a final thought for you to chew on. We talked about those GE9X losses doubling next year. The services business is subsidizing that right now. But what happens if the post-pandemic travel boom finally cools off, even a little? Can that services cash cow keep growing fast enough to cover the billions they're burning to invent the next generation of giants?
That is the multi-billion-dollar question, and it's the risk that keeps the C-suite up at night.
Something to think about. Thanks for joining us on The Deep Dive. We'll catch you on the next one.